Why have all your money in a tax-free account, basically in an equity in your home, that you could use tax-free, but you never use it, by the way, because a loan does not generate a 1099. You don't have to pay taxes on it. You get to use it. And when you die, it all reconciles. It just gets offset on the sale of your home. So let's say you borrow $200,000, you don't pay any interest on it, it grows to $400,000 balance, but your $1 million house grows to $2 million during the same period of time. Both of them double. Well, now you've got a $4 million loan against a $2 million house. There's still $1.6 million in equity. Well, what did you have when you started? You had a paid off house worth $1 million. So you only had $1 million in equity. So even with doing a HELOC or a reverse mortgage or something that generates income for you or peace of mind for you or lets you access some of the equity that you've basically already spent money on, it's like your house should be treated like a bank. That's your money. You should be able to use it if you want to. And if you can borrow from yourself and still get the appreciation in your house and have it continue to grow, then all the better. And, that's kind of similar to alerts. I don't want to jump ship now, but that very similar situation is you borrow against your future death benefit. And when you die, it all reconciles. In the meantime, you make more money on your bank than you do on the loans you take that aren't taxable, never show up in your tax return, never create an uptick in your IRMA. That's the Medicare premiums that you pay. And, you just get through life a little easier without as big a tax bill as you could otherwise have. Why have all your money in a tax-free account, basically in an equity in your home, that you could use tax-free, but you never use it, and then you just pass it on tax-free? Well, there was a lot of tax-free. Instead, you pay taxes on a whole bunch of other income because you keep making income on other stuff, or you sell something you could have made income, and you paid 20 or 30% in taxes to get out of it to pay off a bill or to go on a trip or do something. You're out 30% of the money, whereas you wouldn't be out any of the money at all. You get a step-up basis with no taxes on those other assets if you didn't have to sell them, but instead used equity in your home or loans from LERPs and other asset-based plans that never show up on your tax returns. We like those much better than taxable assets.